Gross domestic product, or GDP, is a term that often pops up in news reports, financial discussions, and economic debates. Yet, for many, it remains a somewhat abstract concept. What does GDP really mean, and why is it so important for countries, businesses, and even individuals? In this video, we'll break down GDP in simple terms, explore its practical applications, and uncover some interesting facts that make this economic measure truly fascinating. GDP. The heartbeat of an economy. At its core, GDP represents the total value of all goods and services produced within a country over a specific period, usually a year or a quarter. Think of it as a giant scoreboard measuring how much a country produces. Just as a heartbeat reflects the health of a living being, GDP reflects the health of an economy. When GDP grows, it generally signals that businesses are producing more, people are earning more, and the overall economy is expanding. Conversely, when GDP shrinks, it can indicate economic trouble, such as reduced spending or job losses. To make this more relatable, imagine a small town with a bakery, a car repair shop, a school, and a local market. Every loaf of bread baked, every car repaired, every lesson taught, and every item sold at the market contributes to the town's economic activity. GDP is essentially the sum of the value of all these goods and services in a given period. Scale this up to a whole country, and you have a comprehensive picture of national economic activity. Different ways to look at GDP. Even though we won't dive into formulas, it's important to understand that GDP can be observed from different angles. Economists often examine GDP through three perspectives: the production side, the expenditure side, and the income side. From the production perspective, GDP counts the total value of goods and services produced by businesses. Imagine a factory making furniture. The value of all the chairs, tables, and cupboards produced during a year contributes to GDP. From the expenditure perspective, GDP looks at how money is spent. This includes consumption by households, investments by businesses, government spending, and net exports, which is the difference between what a country sells abroad and what it buys from other countries. Finally, from the income perspective, GDP measures the total income earned by everyone in the economy, including wages, profits, and taxes. Though these perspectives sound technical, they are really just different ways of answering the same question: how much economic activity is happening in a country? GDP per capita. A measure of prosperity. While total GDP gives a sense of the size of an economy, GDP per capita provides insight into the average standard of living. GDP per capita is calculated by dividing the total GDP by the population of the country. This tells us, on average, how much each person would theoretically have if the country's economic output were distributed evenly. For example, consider two countries. Country A has a GDP of $1 trillion with a population of 100 million people, while Country B has a GDP of $500 billion with a population of 10 million. At first glance, Country A has the larger economy. However, when you calculate GDP per capita, Country A has $10,000 per person, while Country B has $50,000 per person. This indicates that the average individual in Country B is economically better off despite the smaller overall economy. GDP per capita is often used to compare living standards across countries, although it doesn't account for income inequality or differences in cost of living. Still, it is a useful starting point to understand prosperity on a per-person basis. Real GDP versus nominal GDP. Accounting for inflation. One common source of confusion about GDP is the difference between nominal GDP and real GDP. Nominal GDP measures the value of goods and services at current prices, which means it can be influenced by inflation. Real GDP, on the other hand, adjusts for changes in prices over time, giving a more accurate picture of the economy's actual growth. To illustrate this, imagine you run a lemonade stand. Last year, you sold 1,000 cups of lemonade at $1 each, making $1,000. This year, you sold the same 1,000 cups, but the price has risen to $1.10 per cup due to inflation. Nominally, your earnings are $1,100, which seems like growth. However, in real terms, you didn't sell more lemonade, you only charged more per cup. Real GDP would adjust for this price increase and show that the actual production didn't grow. Understanding real GDP is crucial for policymakers and economists because it reveals the true expansion or contraction of economic activity, free from the distortions of rising or falling prices. Why GDP matters. Practical examples. GDP is more than just a number. It has real-world implications that affect businesses, governments, and everyday life. For governments, GDP is a key tool in shaping economic policy. A growing GDP suggests a healthy economy, allowing policymakers to consider reducing taxes or increasing spending on infrastructure and social programs. Conversely, a declining GDP might prompt governments to stimulate growth through investment, subsidies, or tax incentives. For businesses, GDP trends influence strategic decisions. If GDP is rising, companies may expand operations, hire more staff, or introduce new products, anticipating increased consumer spending. On the other hand, a shrinking GDP signals caution, prompting companies to cut costs or delay investments. Even individuals feel the impact of GDP changes. A booming GDP often means more job opportunities, higher wages, and better prospects for financial growth. During periods of low or negative GDP growth, job security can become uncertain, and cost of living may rise if inflation outpaces income growth. Consider the 2008 global financial crisis. GDP across many countries contracted sharply, leading to job losses, reduced consumer spending, and widespread economic hardship. The crisis highlighted how changes in GDP are not abstract numbers but events that touch lives directly. GDP and economic comparisons. One of the most fascinating aspects of GDP is how it allows us to compare economies across time and space. By looking at GDP figures, we can understand which countries have the largest economies, which ones are growing the fastest, and how global economic power is shifting. For example, over the past few decades, China's GDP has grown tremendously, transforming it from a primarily agrarian economy to the world's second-largest economy. This growth has had global repercussions, influencing trade patterns, investment flows, and international relations. Meanwhile, smaller economies may show impressive growth rates percentage-wise, even if their total GDP remains modest. This distinction helps analysts and policymakers understand both scale and pace of economic development. GDP also allows historical comparisons. By examining GDP data over decades, we can see how economies have evolved, the impact of technological revolutions, wars, and policy shifts. The Industrial Revolution, for instance, triggered unprecedented GDP growth in Europe, reshaping society and creating modern economic structures. Beyond numbers. GDP and human well-being. While GDP is a powerful tool, it's important to recognize its limitations. GDP measures economic activity, but it doesn't directly capture human well-being, happiness, or quality of life. A country may have a high GDP but suffer from poor health outcomes, environmental degradation, or inequality. This is why some economists advocate for complementary measures alongside GDP, such as the Human Development Index, HDI, which considers life expectancy, education, and income. Still, GDP remains a central benchmark because it reflects the economic engine that supports societal development. Interestingly, some countries have experimented with well-being budgets, focusing on policies that enhance happiness and life satisfaction rather than simply boosting GDP. Bhutan, for example, has long emphasized gross national happiness over purely economic metrics, showing that economic activity is only one piece of a broader picture. GDP and business cycles. GDP also helps us understand the ebb and flow of economies through business cycles. Economies naturally go through periods of expansion, peak, contraction, and trough. Tracking GDP over time allows economists to identify these cycles, anticipate recessions, and suggest interventions to stabilize the economy. During periods of expansion, GDP rises steadily, employment increases, and consumer confidence grows. Peaks represent the high point of economic activity, while contractions signal slowdowns that may lead to recessions. By monitoring GDP trends, central banks can adjust interest rates, and governments can implement fiscal policies to manage economic stability. For example, if GDP growth slows down significantly, policymakers might reduce taxes or increase government spending to boost consumption and investment. Conversely, if GDP grows too quickly, causing inflation, authorities may take measures to cool down the economy. Interesting facts about GDP. GDP is not only a practical measure but also full of intriguing stories. For instance, did you know that the United States has the largest GDP in the world, surpassing $30 trillion? Or that small countries like Luxembourg have a high GDP per capita despite their tiny size due to concentrated wealth and specialized industries? Another interesting aspect is how GDP can change based on new technologies or innovations. The rise of the digital economy, online services, and gig work has added significant value to national economies, sometimes before traditional statistics fully capture it. Even social media platforms, streaming services, and app-based businesses contribute to GDP, reflecting the dynamic nature of modern economies. Moreover, GDP figures can be surprising when considering the informal economy. Many developing countries have large sectors where economic activity is not officially recorded, from street vendors to home-based artisans. While these activities contribute to people's livelihoods, they may not always be fully reflected in GDP calculations. This highlights both the power and the limitations of GDP as an economic measure. GDP in everyday life. You might wonder how GDP affects your daily life. It shapes government policies on healthcare, education, infrastructure, and taxation. It influences job availability, wage growth, and business opportunities. Even your spending habits, access to loans, and investment prospects are indirectly tied to GDP trends. For instance, during periods of strong GDP growth, governments may increase investment in public services, roads, and technology. Businesses may expand operations, offering more employment. Consumers may feel confident to spend more, fueling further economic growth. Conversely, during periods of weak GDP growth, governments may cut spending or introduce austerity measures, businesses may scale back, and households may tighten their budgets. GDP also affects international travel and trade. Countries with higher GDP can invest in better airports, transportation networks, and tourism infrastructure, making them more attractive destinations. Similarly, GDP influences exchange rates, import-export dynamics, and international business strategies. Use cases of GDP. The applications of GDP go beyond simply measuring economic output. Policymakers, economists, and international organizations use GDP in several ways. One primary use is economic planning. Governments rely on GDP data to set budgets, allocate resources, and prioritize sectors that need support. For example, if GDP data shows that manufacturing is lagging while services are booming, policymakers may introduce incentives for industrial growth. GDP is also crucial in monetary policy. Central banks use GDP trends to decide interest rates, control inflation, and stabilize the economy. For example, if GDP growth is slowing, central banks may lower interest rates to encourage borrowing and investment. International comparisons are another important use. Organizations like the World Bank, IMF, and UN analyze GDP to assess global economic performance, provide development aid, and guide investment decisions. Investors also use GDP trends to identify growth markets and potential risks. Finally, GDP serves as a tool for historical analysis. Economists examine GDP over decades to understand long-term growth patterns, the impact of technological innovation, or the consequences of major crises. For example, analyzing GDP during the COVID-19 pandemic helps assess the economic damage and informs strategies for recovery. Final thoughts on GDP. In conclusion, GDP is more than just a number on a chart. It is a reflection of a nation's economic vitality, an indicator of prosperity, and a guide for policy, business, and personal decisions. While it has limitations and doesn't capture everything about human well-being, GDP remains one of the most powerful tools for understanding how economies function, grow, and interact globally. By thinking of GDP as the heartbeat of an economy, we can better appreciate its role in shaping our lives. Every loaf of bread baked, every car repaired, every lesson taught, and every service rendered contributes to this vital measure. Watching GDP grow can be exciting, signaling opportunity and progress, while observing a slowdown can remind us of the challenges and adjustments needed to keep an economy healthy. GDP is both a mirror and a compass. A mirror reflecting the economic activity around us and a compass guiding decisions that shape the future. Whether you are a policymaker, business owner, investor, or just someone curious about how the world works, understanding GDP helps you see the bigger picture and appreciate the forces that drive prosperity and change.